Right, let's take the discussion forward and also discuss how market is actually reading all of this. Viraj Mehta of Equirius is joining us now. Viraj, of course, runs the PMS at Equirius and is one of the best performing PMS fund managers for FY21. And that too, mind you, he operates in the relatively riskier side of the market, which is mid caps and small caps. And still, he managed to outperform majority, I would say, of the PMS, the over 200 PMSs operating in the country. One of the best ones. Don't have the exact number handy, but I do know that he was one of the top 5 or top 4 best performing ones. Viraj, congratulations on that kind of performance. We'll talk about your portfolio approach and philosophy and all of that. But as a money manager who observes the various elements which work on the market closely, how are you really reading that markets seem to getting slightly nervous now regarding the stricter lockdowns which are happening across the country? What are your thoughts, Viraj?
Thanks a lot for Ajay for having me on your show. It's always a pleasure to talk to you. So regarding market getting nervous regarding the second set of rules which will be implemented and how will it affect some of the businesses, I think we don't have to look very far. We have to just look what happened a year back and what kind of businesses saw a lot of destruction in their earnings and top line and bottom line over that time frame of 3 to 6 months. I think this lockdown will probably be stricter but shorter. It will not be a 3-4 month disruption. It will be at least the way government is talking today, it will be more localized and slightly shorter periods of lockdown. And as we near immunity or in large set of people, either people who have already got or contracted the virus or people who are vaccinated, we will see the duration of these lockdowns being shorter. Now, if history is any set to go by, you kind of know what kind of businesses which will come back the fastest, the first. It may not exactly be the same set of businesses, but I think there is a reasonable evidence to look out what corrects and what to look at. On top of that, there is another set of businesses where there is a large supply challenge which is leading to higher profitability for producers. So multiple factors that we have to look at, but we will just be very wary of adding any new unsecured or corporate financials or any of those. I think more important than what you buy, it is also very important to know what to avoid. So unsecured financials is an absolute avoid in our view at this point.
Right. Viraj, let's talk about your portfolio approach now, because you look at the mid caps, small caps, end of the market, much more alpha generation is what you are mostly keen on. I was looking at your portfolio. You have some of the names like Polycab, etc. Though I do not want a reaction on that particular stock, but the theme which you are aiming at playing here, the home improvement theme, the input providers as far as the construction or the real estate space is concerned. What are your thoughts here? How are you aiming at playing this area?
We think two of the sectors where we see a lot of push. One, as you rightly pointed out, home improvement or new home buying. If you look at the data end of March, the kind of numbers you will see in terms of home registration are at a 7-year high. Obviously, some of those were incentivized due to lower stamp duty on some of the larger cities, but we still feel that the push that this sector is getting after probably a lost decade is kind of significant and should continue. There are multiple ways to play this. Either you can buy some of those input players that we talked or you just mentioned in terms of Polycab, and there is just a little disclosure that I and my family and all my clients hold it. It's our largest position. The industry has kind of stagnated at around 55,000 crores. and if you think the industry is going to double over next 5 years, as a market leader, I think this company can grow from probably 8 or 1,000 crores to probably 22,000 crores. And today, if you think about that, then you're trading it or buying it at like less than 1 time revenue 3 years out, which we think is a significant discount to how the peers trade. And if you look at it as best in terms of ROCs, working capital, cash flows, no debt on books, significant dividend payout, and an extremely efficient distribution and manufacturing capability. So those are the kind of sectors or players that we look at within that sector. You can also look at pipes and some of the similar players in those, though the valuations there are kind of stretched, so we don't own them. The second way to play this is probably look at home financiers. Those are the secured lenders, and there'll be significant push or how money can be made in some of those. Some of the PSU-backed NBFCs will do very well in this space over the next couple of years, we believe. The third place where we are kind of significantly bullish is the new ordering or capital goods sector, which has not done anything for like 10 years. So we are generally a reasonable believer in mean reversion. So we were buying probably pharma and agrochemicals 3 years back. And today we think there is a lot of value in some of these providers, plus some of the capital goods providers. So we also look at those themes could be very constructive over next couple of years.
Right. How are you playing the chemicals theme? I understand that's the second largest weight as far as your overall portfolio is concerned. And chemicals is such a wide area. How are you playing it? Are these chemicals, feeding into consumer side? Is it the auto ones? Or they are, you're playing the API theme, which are input providers to pharma. What are your thoughts there?
Of everything. So we also have API players providing globally competitive, the largest producer of some of the globally competitive APIs in India and supplying and having probably 30-35% market share globally in some of these products. And globally the most competitive players. So one set of players we have there. Now you can pick and choose how do you play these. Like we have one of those names, but there are so many significantly good players here. You can have Suven or a Newland or a Hilal. So many of these players are kind of positioned well, and you can pick and choose what you like. It's kind of multiple ways you can look at it. The second chemicals that we own is we own one of the largest aroma chemicals. So they basically supply to all your FMCGs and you name an FMCG player and they are a supplier to that. And they are undergoing a significant capex ramp up of around 300 crores. And we think the revenue of this company can more than double over the next 3 years. So that's the second set we are looking at, and the third set, as you obviously mentioned, is one of those largest global chemical companies and who's kind of getting market share globally. They are probably 3 or 4% market share. We think they can go to 15-20% over the next 10 years. So there are multiple ways. We think next 5-7 years is going to be great for Spec Chem. Two things you have to make sure is you are not buying one of those companies at a very high end of the EBITDA margins. A company which was doing probably, let's say 18-20% and now is doing 35 or 40%. You kind of don't want to buy them today because on very high margins they're trading at high valuation. That could mean you don't make any money for 4-5 years. That's the only trap I guess you got to avoid in Spec Chem. But in general, Spec Chem is going to have a great next 5-7 years in terms of top line growth.
Right. All right, Viraj, before I let you go, a quick take on, you had a phenomenal FY21. If I'm not wrong, over 200% returns of your portfolio. How does the landscape look now? Are you aiming at bettering your score, or it'll be a difficult landscape from here on, at least this year?
I think one is kind of a wrong benchmark. sorry to, probably, I mean, we think about 3 or 4 year rolling returns because, see, it's also a function of timing because 1 year is kind of end of March where everything was beaten, right? So I think better way to think about it is 4 years, 3 or 4 years. Over 4 years, we have delivered around 25% post fees for all our clients, 4.5 years. CAGR. If we are able to, we think that there is significant runway to probably look at similar kind of return over 5 years. But which would mean that there would be years where we don't return anything, and there will be years where the returns will be huge. So equity returns tend to be lumpy, even more so in small caps. But if you have a 4 or 5 year horizon, I'm pretty sure that there is large money to be made in this space.
Well, that's correct, Viraj. You're right. There are decades when nothing happens in the market, and then there are weeks when decades happen. So it's a complex world. Who says investing is easy? But wish you good luck going forward. And thanks so much for your time today.
Thank you so much, Ajay. Always a pleasure to talk to you.
Let's take a short break. On that note, more news and analysis on the other side. Don't go anywhere.